Let's take a look at how changes in activity levels affect our contribution margin and our net operating income. The contribution margin income statement classifies costs by behavior, that is, fixed or variable, rather than by function, which is how costs are classified in our traditional GAAP-based or external financial reporting income statement. So in our contribution margin income statement, we've got sales minus our variable cost, which in this case are $150,000, leaving the Wynn Bicycle Company with a contribution margin of $100,000. This contribution margin can go to cover fixed costs, and anything that's left over then is pure profit, in this case net income or net operating income. One of the more useful features of our contribution margin income statement is to express our sales and our variable cost on a per unit basis. If the Wynn Bicycle Company had sold 500 bicycles, then the per unit selling price would have been $500. That's the $250,000 in total sales divided by 500 bikes. And our variable cost per unit would have been $300, which is again the $150,000 in variable cost divided by 500 bikes. This means the Wynn Bicycle Company is making a contribution margin per unit of $200 per bicycle. That is, every time it sells one additional bicycle, its net operating income will increase by $200. That's because its contribution margin will increase by that amount, while fixed costs remain constant. We'll find that the contribution margin income statement is a very powerful tool for helping managers judge the impact on profits of changes in a selling price, variable cost per unit, fixed costs, or units of bicycles, in this case, sold. The emphasis again is on cost behavior rather than cost function. Let's use our contribution format income statement to calculate our break-even point. Our break-even point is where our net income is zero. Since our fixed costs are $80,000, then we're going to need to earn a contribution margin of $80,000 in order to break even. We can calculate the number of units or bikes that we need to sell to break even by taking our $80,000 contribution margin and dividing it by our $200 contribution margin per bike. We can see then to break even we'll need to sell 400 bikes. And we can verify this by multiplying our 400 bikes by $500 per unit to get $200,000 in sales revenue, and our 400 bikes times $300 per unit to get our variable cost of $120,000, which would indeed give us our contribution margin of $80,000, which is just enough to cover our fixed cost. Now let's take a look at what happens if we sell one more bike. Notice our contribution margin per bike is $200. This means our overall contribution margin will go up by $200, but with no change in our fixed cost, our net operating income will increase by that same $200. So sales will go up to $200,500. Our variable cost will go up to $120,300, giving us a contribution margin of $80,200. And sure enough, our net income has increased to $200. Let's take a look at some contribution margin income statements at various levels of sales. The Worley Corporation's most recent income statement is shown below. Let's prepare a new contribution margin format income statement under each of the following conditions. Sales increased by 100 units, sales decreased by 100 units, and sales are 9,000 units. Currently we're told sales are 10,000 units, so let's look at the case where sales increased to 10,100 units. Our sales revenue will be $353,500, which is our $35 per unit times 10,100 units. Our variable cost will be $202,000, which is our $20 per unit cost times 10,100 units, giving us a contribution margin of $151,500. Once we subtract our fixed cost of $135,000, we're left with a net operating income of $16,500. If sales were to decrease by 100 units to 9,900, our sales revenues would decrease to $346,500, which is the $35 per unit times 9,900 units. Our variable cost would be $198,000, and our contribution margin would be $148,500. Our fixed costs remain constant at $135,000, which means our net operating income will be $13,500. At 9,000 units, our sales revenue will be $315,000. That's $35 per unit times 9,000 units. Our variable cost per unit of $20 multiplied by 9,000 units gives us a total variable expense of $180,000. Once we subtract our variable cost from sales, we have a contribution margin of $135,000, which is just enough to cover our fixed cost. So we see 9,000 units is our break-even level of sales.